Welcome to the InterMarket Analysis video update. This is a weekly video where I look at a number of different things, not just inside of the S&P 500. We look at the valuation of the S&P 500, and then we look at other markets, and I do a pretty extensive go through of growth versus value, because typically we want growth to be outperforming value when the market's really going up. When value starts to outperform growth, that's when we start to get a little bit concerned. This is being prepared for Monday, December 2nd. Before I get into the video, I want to tell you about the SPX Investing Program. It's up, it's going. There's a link that will take you to the website. There's a link that will take you to a video. If you have questions, you are more than welcome to send me an email here with the address that is provided. Also, the intermarket analysis video is just one of the weekly videos that I do. The real foundation of the analysis that I perform is in the daily video, so please feel free to check those out. All right, let's go through and look at S&P 500 valuation. And I've actually been seeing more posts about this, even though we've been overvalued on a historical and even on a forward-looking basis. It's been a couple of years. I mean, you can just see here, we've been above this red dashed line, which is a PE ratio of 20. And that's usually when people start to freak out about things. But we've just been going up and up and more, up more as we keep going up with the S&P. And then I measure the distance between the S&P and the red dashed line. That's what you see down below. And it's like, okay, this has been going on for a long time. And the market can be overvalued for extended periods of time, many years at a time. So we don't use this as a timing mechanism. We just want to be aware of this. Now, this particular chart looks backwards at earnings that have already come out. And this also looks backwards. And then what were some events that happened and what the valuations were at that time. Another way of looking backwards at the PE ratio was developed by Robert Schiller, where he takes a more smoothed approach, and he's coming in at 38.54. We don't use that 10, 15, 20 scale necessarily. We look at the median and the mean. We're at 16 to 17 here, and we're up at 38. So yeah, even according to this measure, we are overvalued. But the market also looks forward. But even looking forward, we're still looking overvalued. The purple line in here is the mega cap 8, the forward projecting out into the future what earnings will be. It's coming in at 29.1, and the S&P is at 22.1. We're well above that 20 level. And even the mid caps and the small caps, which are seeing a little bit more favor right now, they've been camping out between 14 and 15 or so. They're starting to go up as well, but they're not necessarily overvalued. They're coming in at 17.1 for both the mid caps and the small caps. And then this is another chart that kind of goes hand in hand with that. It says U.S. equities look expensive again, and that's based on what we just looked at, but bond yields are near their long-term average. So when you compare stocks and bonds to each other, according to this chart, we still might have more room to run, even though on a forward-looking PE ratio, we're still looking pretty expensive. All right, then we look at growth all by itself. This is a pure growth index, which you can see is clearly in an uptrend right now. The blue line is above the red line. The blue line is a 50 period moving average, and the red line is a 200 period moving average. And we look at value, which is also in an uptrend. Then we do ratios between growth versus value. And as long as we're in an uptrend here, which is what we're seeing right now, growth is outperforming value. Then because they calculate in a slightly different way, you can see these moving average crossovers were slightly offset with each other. This bottom chart is an inverse showing how value is underperforming growth. And you're going to see that through all these charts. And the reason I look at so many charts is just to see, okay, are we seeing a lot of confirmation when we look at different time frames, when we look at different indexes, we look at ETFs. Here is an ETF, which goes all the way back to late 2004, also showing how growth is outperforming value, how value is underperforming growth. So we're seeing more confirmation here. Then we look at the same index, the growth index, with the pure value index, also showing how growth is outperforming value. This is an inverse, but a little shorter time frame. This is showing how value is underperforming growth. And then we look at another ratio between growth and value, showing that growth is outperforming here. Then we break it down a little bit more. Just look at the small caps, growth to value, and take a ratio there. We are improving with the overall ratio, but we're still in a downtrend. And with the mid caps, also in a downtrend, but are improving. Then we also look at a growth ETF versus a value ETF, showing how value is kind of underperforming right now. It's coming back down into the rainbow. And this also shows how value's been coming back up a little bit lately when compared to growth. But then the area that I focus on the most is S&P growth of value. And we're still in a longer term uptrend here. We're not really breaking out, but we're not breaking down either. So for the time being, this is holding up fairly well, but we would really like to see this doing better than what it's doing right now. Then we look at a long-term chart of inflation as measured by commodities. This is a monthly chart of the CRB index, which is the commodity index. And we're pretty much going sideways. And we've been going sideways now for quite some time. Then we look at an inflation versus deflation ratio, and this is going down as inflation has been going down. But then we look at the CRB index. This is a daily chart where it's actually crossing down and giving us a death cross here. But then it's been coming back up and we're getting kind of close, but we're not quite at the point where we're seeing a golden cross here with the overall trend of the CRB index. And then we look at the Baltic Dry Index. And as I say every week, the general rule of thumb is when this is going up, that's more inflationary. That means it costs more to ship products. When this is going down, that's more deflationary. And we're continuing to fall here after we spent most of the last year or so pretty much going sideways with this index. And inflation expectations actually coming down a little bit, but overall they have been going up since we had the whole COVID crash. And if this comes down, that just means that inflation is expected to go down as well. We also keep an eye on some other markets where here we have aluminum, which is in an uptrend, wheat, which is in a downtrend, corn, which is going up, but still in an overall downtrend. Look at fertilizer, not really breaking to the upside or downside right now. That could be inflationary. Oil has been dropping down, watching this mainly for geopolitical reasons. And there's a ceasefire, supposed ceasefire, going on in the Middle East right now between Hezbollah, Hamas, and Israel, which means when you say Hezbollah and Hamas, that means Iran. And then we look at a gold to oil ratio. When this is going up, that means gold is outperforming, and that's been actually performing better than oil. Then we look at a correlation between oil, which is the red dashed line, which has been coming down, and then the 10-year yield, which has also been coming down over the last week or so. So we're seeing this correlation actually show a little bit of an improvement, but we're still pretty much neutral. When we're at this 0.25 plus to 0.25 minus, that's considered neutral. Gas is in an overall downtrend. Natural gas is starting to show a bit of an uptrend as we're coming into the winter months now. Heating oil is also it's still in a downtrend though. Diesel also not really breaking to the upside or to the downside. It's been chopping sideways lately. Then we look at a copper to gold ratio. When this is going down, that means copper's underperforming gold. This is a longer term chart of that same ratio, also plotting the 10-year yield and the 2-year yield. And we're seeing a real disconnect between this ratio going down and interest rates have been going up. Where if you look at other times, the yields and the copper to gold ratio tend to move in the same basic direction. This has been happening now for quite a while, and we're potentially seeing some kind of a shift in the overall economic climate. We're not really quite sure what that conclusion is for right now. And then we are still in an uptrend here when we look at the daily chart of copper, but it's been pulling back lately. Gold pulling back after hitting all-time highs, but still below its 50-day moving average. Silver actually below its 50-day moving average lately. Then we look at a gold to silver ratio. When this is going up, gold is outperforming. When this is going down, silver is outperforming. And we compare it to the US dollar index, and it's coming down a little bit here, but there's a pretty strong correlation between precious metals on top and the ratio and the dollar, which is a currency down here below. Then we look at the closing price of gold, the closing price of silver, and actually this correlation has been trailing off a little bit lately, but it's not quite down to the neutral area. Now, you would think if gold goes up, silver should go up. They tend to move in unison with each other, and for the most part, that's true, but we're seeing a bit of a disconnect right now. Here is the US dollar index. We're just starting to see a golden cross here. Not quite there yet. We probably will, but as can quite often happen with moving averages, we had a death cross here and then we started to go up. Now we're starting to go up above these lines and we see a golden cross, and now the dollar's been coming down. That's one of the shortcomings of using moving averages, but I still use these to measure the overall trend. Then we keep an eye on the euro, which has really been falling down compared to the dollar, but lately it's been bouncing back up. We also keep an eye on the Japanese yen, which had been declining, but starting to go back up as the dollar saw some weakness this past week. And then here's euro, the euro all by itself to the dollar, where it's in a downtrend now, but it has been bouncing up over the last few sessions. And this is put out by Bloomberg. It says the euro is having its worst month since May of 2023. Yeah, the euro's really been down. That means the dollar's been quite strong. And a lot of that has to do with the election being over and that everything has worked out okay to this point. The Japanese yen is in an uptrend still compared to the dollar, but it's really been pulling back. But over the last few sessions, it's been bouncing back up. Then the British pound, below both of the moving averages, but also rebounding a bit here. Still in an uptrend, though, when compared to the dollar. Then we look at the S&P 500, which is a weighted index. And then the red line is an equal weight version of the S&P 500, and we're not seeing much of a disconnect right now. And this is actually more positive for the broader part of the S&P. It just means that it's not just a few stocks that are really driving the index right now. And we look at a ratio between the equal weight and the weighted version of the S&P, kind of chopping around a little bit as the broader part of the S&P has been performing better. Then we look at a stock to commodity ratio. This shows stocks are outperforming. This next chart shows how commodities are underperforming stocks. And we look at the NASDAQ 100, which is now underperforming the rest of the S&P 500. Earlier in the year, the NASDAQ 100 was really outperforming. Then we hit that high over the summer, and now it's been starting to underperform, which is okay. But if we really want to see the NASDAQ 100 and the S&P 500 do a lot better, we want to see the NASDAQ 100 outperforming. But it's still positive. They're both doing really good when you look at them individually. The S&P 100 falling back a little bit compared to the rest of the S&P, but still in an uptrend. But if we stay below these lines, we could actually see a death cross here with this ratio. And this is the NASDAQ, which has actually been outperforming the NASDAQ 100, which I'll show in just a second. This is starting to outperform the S&P 500, and this is a broad index, and the fact that it's doing well just means that more tech stocks, because that's mostly what the Nasdaq is outperforming the S&P 500, even though they're both doing quite well. Here's the Nasdaq 100 showing how going back to over the summer months, even back into the spring, how the Nasdaq 100 has been underperforming the Nasdaq. Small caps seem to be the real area of favor right now. Longer term, they're still underperforming the S&P 500. We haven't seen a golden cross yet with this ratio. And this red line just shows the small cap to S&P 500 ratio. The blue line is the S&P itself. Still quite a disconnect as the S&P has been really outperforming the small cap to S&P 500 ratio. And we look at the mega cap stocks, the really, really big companies that everybody loves to talk about, and compare them to the equal weight ratio, going sideways for the most part, but still in an uptrend. Then we keep an eye on the advanced decline line, not only for the S&P, which is the second area down, setting a new all-time high here. We keep an eye on the NYSE common stock, which is close to the all-time high. We also want to keep an eye on the mid caps and the small caps as far as their advanced decline lines as well. And transports finally breaking out a little bit. Then we saw some weakness, and they're doing a little bit better now. We look at a ratio between the Dow and the transports, and this had really been coming down, showing how the transports were outperforming. When this goes up, that means the Dow is outperforming. And then we do another ratio between the transports and the S&P 500, which shows how the transports had really been underperforming. They are starting to improve. And if we see the economy continue to go in a good, solid direction, we might see the transports begin to outperform on a longer term basis. And we look at the relationship between the S&P and the transports, and it's pretty strong right now when it gets up into this red area. That just means that if the S&P is going up, typically the transports are going up, or if they're both, they both could be going down at the same time too. And then we're setting a recent all-time high. In fact, in Friday's session with the Dow off of the highs with the transports, utilities were seeing some weakness, but they've been roaring back pretty good lately. That tends to be a little bit more defensive, so we want to keep an eye on that one. And then instead of using traditional Dow theory, we use the S&P 500, which is setting an all-time high, and the Nasdaq, which is not at an all-time high yet. So this would be a non-confirmation. We want both of these within a reasonable amount of time to both be setting new all-time highs. And then we break it down a little bit more and look at the equal weight, which is setting an all-time high. And we're just off of an all-time high with the QQQ's equal weight. So when you break it down to the NASDAQ 100 and treat all stocks equally there, yeah, we're seeing a confirmation here, but we're not seeing it in the broader market, at least yet. The Wilshire 5000, a broad market measure, did set an all-time high on Friday. The total US stock ETF, also a new all-time high. Mega cap growth coming off of just almost back to a new all-time high and in a solid uptrend. The big software companies have been doing quite well lately. And then the robotics and AI ETF in an uptrend when you look at it by itself, but not really outperforming when you compare it to the tech sector. Then the Dow Jones Composite Average, which is the Dow, the transports, and the utilities together, setting an all-time high here. Low volatility stocks, when you look at them all alone, they are in a really solid uptrend, but they're improving. But when you compare it to the S&P, they are really underperforming. The FANG index, not at an all-time high yet. These are the big companies: Facebook, Apple, Amazon, Netflix, Google, Nvidia, companies like that, but still in a really solid uptrend. And we keep another eye on this. This is a short-term trend line, which we've not been able to close above this short-term line, but we've been able to stay above this longer-term trend line. So we're just keeping an eye on this for support and resistance reasons. ARC showing some improvement, actually in an uptrend now. And the stocks throughout the whole world, but excluding US stocks, came down to their 200-day moving average and are starting to bounce up off of that. But when we compare US stocks to the rest of the world, US stocks continue to outperform. Then we look at a ratio between the small caps and the tech sector, kind of bouncing around right now. We might be getting ready to see a golden cross here with this ratio. If we do see a cross and this continue to go up, that means that the small caps are outperforming the tech sector, which is not necessarily a positive thing for the market. We'd like everything to do well. Small caps, they can go up as much as they want, but we would like the tech sector to go up too. And then we look at a monthly chart here. The price of the 30-year bond ETF based on price fell down below its moving average, showing a little bit of an improvement here after it had been declining for years. And then on the bottom, we have a long-term bond based on price and then a ratio with commodities. And the long-term bond price still continues to outperform. Then we look at the relationship between stocks and bonds. First, we look at bonds based on price. Came down, kind of danced around its 200-day moving average, was able to bounce up off of that, and now dealing with its 50-day moving average. We're above 50 with the RSI, and the momentum as measured by the MACD is also still positive. Another ETF based on the price of bonds, where we're coming back up, but we're still below the 50-day moving average. The Pring World Bond Index, this is also based on price, where we're still in an uptrend, but the 50-day is really coming down, and even the 200-day is declining as this has been really choppy lately. Then a monthly chart of the stock to bond ratio. This just continues to show how stocks are outperforming bonds. Stocks based on price, bonds based on price. And this just confirms that as well. Bonds based on price are underperforming stocks. Investment grade bonds, more conservative bonds, pulling back but showing some improvement now. And these are typically thought of as being more safe. Then we compare them to junk bonds, which are setting recent all-time highs here. Then we do a ratio between junk bonds and more conservative bonds. And we've really been seeing junk bonds outperforming here. It's been pulling back lately as interest rates have been coming back down. But folks are willing to assume more risk to get a better yield. We're seeing the spread between the risky and conservative bonds really thin right now. So there's not a lot of fear that's being put into the bond market right now. And then we look at the stock to bond correlation, pretty strong right now. So stocks based on price and bonds based on price are typically going in the same direction at the same time. In the Dow Jones Corporate Bond Index, coming back up and trying to get above its 50-day moving average. And nothing really to see here. These are fib retracement levels based on the 10-year yield. This is also the 10-year yield longer term, how we're going up into a higher area now. And this is also a fib retracement study, but we're not near any of the lines here with when we look at the yield. Then we look at the S&P 500 and compare it to the 10-year yield, showing how the S&P had been pulling back, but is now starting to outperform the 10-year yield or the interest rate. Then this is another measure where we compare bonds to stocks. And when this is going down, that means bonds are underperforming. Junk bonds, generally considered to be more risky, just coming off of setting recent all-time highs. And then we look at a ratio between junk bonds and more conservative bonds. Had been pulling back, but now junk bonds have been outperforming. There's a daily chart of the yields where we were coming down, then the Fed cuts rates, and then yields start really going back up. Figure that one out. Now, over the last few trading sessions, we've been coming down, and that's giving more support to stocks. This is a weekly chart looking internationally, where we're also coming down with US and UK rates as well as German rates. Japanese rates came down just a little bit, but not very much. That's the red line. Then we want to keep an eye on the volatility of bonds as measured by the MOVE index, and the volatility of stocks as measured by the VIX, and see that there's a pretty strong correlation. Now, this is not price. This is measuring the volatility of bonds to stocks, and they seem to be going in the same direction as far as volatility is concerned because we've been going up with stocks, so the VIX goes down. We've been going up with the price of bonds, so the yield goes down. So volatility has been going down as well. And we look at stocks and then compare it with 1 to 3 year bonds based on price, showing how stocks are outperforming here. We look at the S&P 1500 and also compare it with short-term bonds, showing how stocks are outperforming here. Another broad market measure looking further out, the 3 to 7 year bonds shows stocks outperforming here. The tech sector not just breaking out above the rainbow, but still holding up okay when compared to 3 to 7 year bonds. Then we go through different sectors, and the first chart is just the sector itself, where materials came down, broke through its 50-day moving average, found some support just above its 200-day moving average, and have been bouncing back up. We might be hitting some overhead resistance trying to get back through the 50-day moving average. But when we compare it to the S&P, materials are underperforming. Communication. This is one of the real growth areas, looking really solid all by itself and also doing well when compared to the S&P 500. The communication sector continues to outperform. Energy, which came down, we actually saw a death cross here, but that didn't last for very long. Then energy started to go back up. This may have been more geopolitical in nature. It's been pulling back lately. But when we compare it to the S&P, really underperforming and in a downtrend. Financials, another darling area of the market right now, coming off of recent all-time highs and also outperforming the S&P 500. Industrials looking really solid all by themselves and actually in an uptrend when compared to the S&P 500. This tends to go more with the economy. If the economy is doing better, industrials tend to do better. The tech sector, another stronger area, but seems to be kind of in some short-term weakness. Actually, not necessarily short-term. This has been going on for a while now. And underperforming the S&P 500. And that's a bit of a concern. Staples, which is toilet paper and toothpaste, falling back below its 50-day moving average, but then was able to get back above that. But when we compare it to the S&P, even though it's been recovering with this ratio, it's still in a downtrend. Real estate, which doesn't like interest rates going up, so real estate was going down, but lately with interest rates coming back down, real estate's been going up, but kind of it's still in an uptrend compared to the S&P, but showing an awful lot of recent weakness. Utilities coming off of an all-time high here, and that tends to be more defensive, but you might think of this as a growth area, with all the electric vehicles and all the Bitcoin and crypto mining and the green stuff that's supposed to be hitting the economy. Maybe utilities are more of a growth area right now because the world's going to need a lot of electricity. And doing pretty good when compared to the S&P 500 in an uptrend, but not really breaking out right now. And then we look at an S&P to utilities ratio, and for a while, long time, I would show this chart every day in the daily video. I had dropped showing it because we're just chopping around between this. And then we look at healthcare, which has been under some pressure lately, but coming back up to its 200-day moving average, but still bouncing back up a little bit, but still in a downtrend when compared to the S&P. Discretionary, this has been a really strong area of the market, and you can see by looking just at this chart, and it's really improving enough to give us a golden cross here with the ratio compared to the S&P 500. And this is a concern, though. This is another area of tech. We're dropping below the 50 and 200-day moving averages here with the semiconductors, which is a huge part of tech. We've actually seen a death cross here on the daily chart. If this continues to fall, that's going to be a concern. Now, if we can get back above this, we've fallen below it before, but the longer we stay under here, the worse these lines are going to look. So I've been watching the semiconductors pretty heavily. In fact, I've been showing this chart in the daily videos just to try to keep up with things. We look at the energy sector to tech sector ratio down here, showing how the energy is outperforming, even though it bounces back up and improving a little bit, but still in a downtrend. We look at the growth stocks and compare it with bonds based on price, how growth stocks are outperforming. And then we can look at the tech sector compared to the 10-year yield, actually bouncing back up a little bit here as rates have been coming down, and the tech sector has been holding up fairly well. This is an inverse showing how the 10-year yield is underperforming the tech sector. Discretionary to staples. We like this. This is happy for the market. When we see a recent golden cross here and discretionary is really outperforming staples. Discretionary things like Tesla, Amazon, the thing that makes life fun. The things that you do when things are going good and you do away with when things are going bad. Or staples are toilet paper and toothpaste, the things you have to have no matter what's going on with the economy. And then this shows how staples are underperforming discretionary. The gold to S&P ratio kind of chopping around, but gold is in an uptrend with this ratio. We also look at a ratio between gold and the dollar, and this is going up. That means gold is outperforming. Gold was seeing some profit taking as the dollar was going up. Now with the dollar going back down, gold is starting to outperform again. This is another barometer that I use of the overall economy. These are high leverage loans, very risky. And this is coming off of an all-time high here. So this is not showing any real economic concern. The NYSE composite, another broad market measure, all-time high. All stocks, which are US and international stocks, just barely setting a new all-time high. Emerging markets coming down to their 200-day moving average. They've been lagging a little bit lately. And micro caps, which are smaller companies, they are in an uptrend now. And we're getting kind of just jumbled around these recent all-time highs with the Japanese Nikkei index. And we keep an eye on the home builders, but we're not really getting anything from this chart right now. I follow this down below. It just shows that the S&P and the home builders ETF are strongly correlated. We're looking for times when they diverge from each other. Right now, they're converging. Bitcoin still can't seem to get above 100K, but it's close. And then we look at the trend internationally, where we're in a downtrend in China, downtrend in emerging markets, trying to establish an uptrend in Europe, turning back up in Japan, and starting to establish an uptrend here in the US. And this is a KST, a very long-term oscillator that can take quite a while to shift. InterMarket Analysis showing gold just barely outperforming stocks year to date. Green right here, this is the dollar, the red is oil, and then bonds based on price, even though they're improving, are still down year to date. Then we look at some correlations, and we're neutral when we compare the S&P 500 to the dollar right now. And the S&P to oil also coming into that neutral area. The tech sector, the 10-year yield, actually having a slight tendency to go in opposite directions now. So if the tech sector is going up, then possibly the 10-year is going down. And we look at the S&P to the 10-year yield, also Real strong tendency to go in opposite directions. Interest rates coming down, which is the red dashed line here, and that helps the S&P to go higher. And then the S&P to the 2-year yield, also pretty strong tendency to go in opposite directions. The S&P's been going up as the 2-year yield's been coming down. Then some long-term measurements here. This is a monthly chart of the NYSE, setting an all-time high here, well above the long-term moving average. The Kopic curve, which is a momentum oscillator, is positive. Then this is a daily chart, and we're continuing to go up here. That's positive. The S&P monthly chart also just setting a new all-time high and starting to turn back up with the other momentum oscillator that we use here. Then we look at the S&P on top, and then a ratio between stocks and commodities, also showing in the longer term how stocks are outperforming. And then we do another ratio of US stocks to global stocks here on a monthly basis, showing how US stocks are outperforming. Been going sideways here with the KST, again, the long-term oscillator, just barely starting to go up here with the blue line crossing above the red line. Then at the very end, I list all those things that are positive. My definition of positive is when the 50-day moving average is above the 200-day moving average. So when you look at growth and value all by themselves, they're in uptrends, as is copper, the British pound, and the euro against the dollar. We're getting really close with the dollar being in an uptrend too. The Japanese yen to the US dollar, even though all of these currencies have been pulling back recently, they did rebound over this past week. Gold and silver are in uptrends, as is the big software companies, or as are the big software companies. The mega caps, the FANG index, ARK, the low volatility ETF, when you look at it by itself, staples are in an uptrend. The Dow Jones Composite Average, when we still look at bonds based on price, with the different ways that we look at them, they're all still in uptrends. Even though they've been showing some weakness, they could be starting to recover. The tech sector, high leverage loans, that's another barometer of the economy. The Dow, the NYSE Composite, and Wilshire, those are two broad market measures that I look at. The NASDAQ and NASDAQ 100, mid caps, small caps, and micro caps. All of these are in uptrends now. All stocks, emerging markets, and of course, Bitcoin. Now, on the negative side, when the 50-day moving average is below the 200-day, we have the CRB index, still seeing a downtrend there. And we're getting really close with the US dollar index. A week from now, we might be in an uptrend here. And then the semiconductors, as I mentioned, we're watching this. We're a little bit concerned about this. We want the semiconductors to be doing better. Now, there was some news that came out this week. Part of what's been pressuring the semiconductors are these increase of regulations and restrictions for semiconductor companies to be able to do business with China. Well, it came out this week that the Biden administration may lessen some of those restrictions, and that's helping the semiconductors bounce up. We'll just see if there's more follow through with that. Thank you. I hope you have a wonderful weekend, and I will talk to you in the next video.